Cryptocurrency futures trading is a form of derivative trading. Derivatives are financial instruments that derive their value from an underlying asset. In this case, the underlying asset is a cryptocurrency like Bitcoin or Ethereum. Futures contracts are agreements to buy or sell an asset at a predetermined price on a specific date in the future. Unlike spot trading, where you buy or sell the cryptocurrency immediately, futures trading allows you to speculate on the price movement of cryptocurrencies without owning the actual asset. This type of trading offers flexibility and the potential for significant profits. However, it also involves substantial risk, especially with leverage. Futures trading is not suitable for all investors, and it's crucial to understand the intricacies before engaging. In futures trading, you can take two primary positions, long and short. A long position reflects a bullish sentiment where you expect the price of the cryptocurrency to rise. Conversely, a short position represents a bearish sentiment where you anticipate a price decline. When you go long, you agree to buy the cryptocurrency at the predetermined price on the expiry date. If the price goes up as you predicted, you can sell the contract at a profit. Conversely, if the price falls, you incur a loss. Shorting works in reverse. You agree to sell the cryptocurrency at the predetermined price. If the price goes down, you profit by buying it back at a lower price. However, if the price rises, you'll face a loss. Leverage is a key feature of futures trading. It allows traders to amplify their potential profits by multiplying their buying power. Essentially, you're trading with borrowed funds, which can magnify your gains. For instance, with 10 times leverage, a 10% price increase can result in a 100% profit on your initial margin. However, leverage is a double-edged sword. It also amplifies potential losses. If the market moves against your position, even a small percentage decline can lead to significant losses, potentially exceeding your initial investment. Therefore, it's crucial to use leverage with caution and consider your risk tolerance. Risk management is paramount in futures trading. Due to the volatile nature of cryptocurrencies and the use of leverage, losses can accrue quickly. Implementing robust risk management strategies is crucial to protect your capital. One vital strategy is setting a stop-loss order. This order automatically closes your position when the price reaches a predetermined level, limiting potential losses. Another crucial aspect is position sizing. Never risk more than you can afford to lose on a single trade. Diversifying your portfolio across multiple cryptocurrencies can also mitigate risk. Furthermore, thoroughly researching and understanding the market before trading is essential. Never trade based solely on speculation or emotion. Even experienced traders make mistakes. However, understanding common pitfalls can help you navigate the market more effectively. One common mistake is overtrading. Trading too frequently without a solid plan can lead to impulsive decisions and losses. Another pitfall is chasing losses. After a losing trade, some traders try to recover their losses quickly by entering new trades without proper analysis, leading to further losses. It's essential to approach trading with a clear mind and avoid emotional decision-making. Lack of research and understanding the market dynamics is another common mistake. Before entering any trade, thoroughly research the cryptocurrency, its fundamentals, and the factors influencing its price. Section 6. Strategies for successful futures trading. Successful futures trading requires a combination of knowledge, strategy, and discipline. One popular strategy is trend trading, where traders identify and capitalize on established trends in the market. Another approach is scalping, involving profiting from small price fluctuations over short periods. This strategy requires quick execution and a deep understanding of market order books. Technical analysis, utilizing charts and indicators to predict future price movements, is also commonly employed. Additionally, staying informed about market news and events that could impact cryptocurrency prices is crucial. Section 7. The evolving landscape of cryptocurrency futures. The cryptocurrency futures market is constantly evolving. New trading platforms and products emerge regularly, providing traders with more options. Decentralized futures exchanges are gaining traction, offering increased transparency and security. Moreover, the regulatory landscape surrounding cryptocurrency futures is also developing. Governments worldwide are implementing regulations to govern this emerging asset class, aiming to protect investors and prevent market manipulation. Staying abreast of these changes and adapting your trading strategies accordingly is crucial for success in the long run. Continuous learning and refining your understanding of the market are essential in this dynamic environment. Section 8. Conclusion. Navigating the futures market. Cryptocurrency futures. Trading offers the potential for significant profits but also comes with inherent risks. Understanding the mechanics of futures contracts, long and short positions, and the impact of leverage is paramount. Implementing robust risk management strategies, including stop-loss orders and position sizing, is crucial to protect your capital. Avoiding common trading mistakes like overtrading, chasing losses, and neglecting research can enhance your trading performance. Continuously educating yourself about the evolving cryptocurrency futures landscape, including new platforms, products, and regulations, is vital for long-term success. Remember, patience, discipline, and informed decision-making are key to navigating the exciting yet volatile world of cryptocurrency futures trading. Section 9. Disclaimer. This essay is for informational purposes only and should not be considered financial advice. Trading cryptocurrencies, including futures, involves substantial risk and may not be suitable for all investors. Always consult with a qualified financial advisor before making any investment decisions.